A review for test 3 in advanced accounting. So your first 3 problems come from chapter 7, where we are dealing with the change of foreign currency values. So the first one we have, we're making a purchase. So we're purchasing product from a supplier, and the bill is to be paid in Swiss francs for $4,000. On that date that we make the purchase, the exchange rate is that it takes $1.18 US dollars to buy a Swiss franc. So then that's how we value it. So we debit our inventory, 4,000 Swiss francs times the exchange rate gives us a value of $4,720. Put that up into an accounts payable. Then on December 31st, when we prepare our financial statements, we have to make sure that all of our assets and our liabilities are properly valued. So we look at this accounts payable because we haven't paid it yet and say, what's the current exchange rate? So we know we owe 4,000 Swiss francs. Now the exchange rate has gone down, so it's $1.05 to buy 1 Swiss franc. So then really we're doing good. So we'll really only owe $4,200. So we have to reduce our accounts payable, so we debit that. And again, because the currency translation rates changed in our favor, we end up with a gain of $520. So there's a foreign currency translation gain. Then on February 20th, it's actually due and payable. So on that date, it's gone back up a little bit. So we've reversed that gain. So we have it now, it's $1.12 to buy 1 Swiss franc. So now we are going to settle our accounts payable though. So the balance as of the end of the year was 4,200. So we debit that to take it off of the books. We have to pay at the current translation rate. So that's 4,000 Swiss francs at $1.12 of Swiss franc. So it's going to cost us 4,480 US dollars. So then now we have a foreign currency translation loss. So don't debit the gain. Anytime it's a debit, take it to the loss. And in effect, they'll net each other out, but we'll still take it to the loss when we do our journal entry. So then that completes that. Then in the next transaction, we're on the other side. We're selling. So we're selling to a product or a product to a customer. And the payment's going to be made in euros on March 15th. The sale happens on December 15th. And it's 10,000 euros. So on December 15th, when we record the sale, ignoring the cost of goods sold part, just the sale only, the exchange rate is that it's $1.58 to buy 1 euro. So they're gonna owe us 10,000 euros at $1.58. So our accounts receivable is going to be 15,800. And our sales are 15,800. Now then at the end of the year, again, we have to make sure that our assets and liabilities are fairly stated. So we come in to this accounts receivable and look at it to say, okay, well, is this really the value? So on December 30th, now it takes $1.60 to buy a euro. So then if we're going to get 10,000 euros, that accounts receivable is now worth $16,000. So again, this is in our favor. So then our accounts receivable goes up by $200, and we have that foreign currency translation gain of $200. Then in March, the account gets settled, so they pay us, and on the date that they pay us, the exchange rate is $1.63. So now we get $1.63 for every euro. So that times the 10,000 euros, we'll get $16,300. We eliminate the accounts receivable at what the balance was at the end of the year. And then again, now we have another foreign currency gain because the money's coming into us. So even though, in a sense, if you look at it, the US dollar is losing its power, like it's taking more US dollars to buy the euro. When we're the collector of the euros, when the money comes to us, that's to our favor. Okay, then the last one from chapter 7 is a futures contract on cotton. So again, when people trade in these commodities or they sell in these commodities, the stock price can change the value of your inventory. So what companies will do is they will enter into futures contracts to lock in the price of that inventory. Sometimes it's to their favor and sometimes it's not. So it's kind of the luck of the market, but at least they can always count on the price. So then we have that they purchased 2,500,000 pounds of cotton, and the purchase price was $1.05. So to record that, we're going to debit inventory for the 2,500,000 times $1.05, and then set up an accounts payable to pay that. And again, the accounts payable is going to get paid right away, so we don't have to go back and worry about the value of that. It'll get paid in its 30 days or whatever, so that's not really an interest to us. What we're focused on is the value of the inventory. So again, to protect their inventory, then they enter into a futures contract that's going to lock the price of that 2,500,000 pounds at 98 cents a share. So on that date, there's no entry required because there's no change in value. All they've done is entered into a contract. They may disclose it, but they don't have to value it and do a journal entry. Then at the end of at June 30th, when they're preparing their financial statements, again, they want to make sure that their inventory is properly valued and that this future contract, if there is value to it, is recorded. So what we do for the inventory, there's two entries then. We look at the inventory to say, okay, let's change the values if we need to. So in this case, it goes down. So it was $1.04 and it drops down to $1. The spot rate does. So we lost 4 cents of value on that inventory. So we take the 4 cents times the 2.5 million pounds. We're going to charge cost of goods sold for the 100,000 and then reduce the value of the inventory by 100,000. The futures contract, we look at the futures price. So the future price went from 98 cents down to 92 cents. So that's a 6 cent drop. Now the key is we have the contract to sell it, which means they're going to pay us. If the price goes down, they pay us. If the price were to go up, we would pay them. So we're saying, we're going to bet it's going to be 98 cents. It goes down to 92. So the person who entered that contract with us owes us those 6 cents. So the 6 cents times the 2.5 million gives us $150,000 in this futures contract receivable, and then we credit cost of goods sold. Now then when we actually sell the cotton, there's a series of entries. So first we're going to actually close the futures contract. The person who entered the contract with us now owes us the money. And then we look at, well, what is the actual rate? So we entered into the contract at 98 cents. The spot rate is now down to 88 cents. So they owe us 10 cents per pound of cotton. So 10 cents times the 2.5 million gives us $250,000 cash coming in. We take the futures contract off of our books. It's only at this June 30th balance. And then the remainder is a credit to cost of goods sold. Then we come through and look at the inventory. Well, now our spot rate has gone down to 95 cents. So it was $1 June 30th. Now it's down to 95 cents. So that's a 5 cents decrease. So 5 cents times the 2.5 million gives us $125,000 that we need to reduce our inventory values down to. And then we charge that off to cost of goods sold. Then we actually sell the cotton. So we set up an accounts receivable for the 95 cents, again, what that closing price is on that day, or the spot rate on that day. So we'll get $2,375,000 in sales, set up that receivable. And then to figure out how much you are going to charge off to your cost of goods sold, you have to look at how the inventory is valued. So I've done a little T account. It started at $2,625,000, but based on the entries that we made, we have reduced it down to $2,400,000. So that's what we charge off to cost of goods sold, and that's what we take out of our inventory. So sometimes these work out to the company's benefits, and sometimes they don't. Sometimes they lose money, but at least they know they can count on the price that they entered into that futures contract for. It helps them from a planning standpoint. Okay, then we have an estate entry. So this is kind of lengthy, so look over at your review sheet to kind of go through them line by line. But this first entry is where we set up the initial estate principal. So what cash did they have? The cash goes to cash principal. They have stock and bonds, and those are going to be at the fair value. We don't care what the person who passed away, we don't care what their cost is. We care what is it on the fair value on the date of death. Then there was some interest that was due on those bonds, and there was some dividends that was due on the stock. So we'll set those up as separate receivables on, again, as of the day of death. Then as the money comes in, as we start to collect on those dividends or anything, it goes into our cash principal, because eventually we really want to turn all of this stuff into cash principal, and then we'll distribute it. Then they discover that, hey, she had a tract of land that nobody knew about. But again, you look at what's the fair value of that land. So the fair value is the $110,000. And then instead of crediting estate principal, we credit assets subsequently discovered for that $110,000. Then she has her final expenses, so funeral expenses, legal bills. What did she owe the IRS? Was there any credit cards or small debts that had to be paid off? So then all of those will get paid off, settled to the estate, and come out of that cash principal. Then as we move over here, then she earned some money. So we still have no, that's not the, oh wait, that goes back to the, this one here. This one goes back to settling those bills. So if we looked at the details of the problem, it said that $500 related to the income that the estate is earning. So if there's income or expenses that are incurred after the date of death, relating to the estate, then it's an expense against income, and it comes out of cash income. So we keep those accounts separately from the cash principal and the principal estate. Okay, then the next thing that happens is we sold the stock. So we had that Bayside stock. It had a fair value of $235,000 on the date of death. Now it's a couple months later, and we sold it for $250,000. So then we would have a gain on the sale of that stock for $15,000. But again, that goes into our cash principal, because our goal is to convert all of these estate assets into cash so we can distribute it. Then the next thing that happens is we sell the bonds. So we sell the bonds for at a premium plus our accrued interest. So this calculates out the premium. We sold them for $513,600. And then we collected on the interest receivable that we had set up, because then we also got paid the interest. We remove them at the fair value on the date of the death, and you can see that we end up with the gain on the sale. The difference between the $513,600, the $510,000 that we had it valued at was our gain. Then we received the interest, so that's the cash coming in and reducing that interest receivable. Now then there was 4 months of interest income that was coming in after the date of death. So again, just like we did with these expenses, we keep those separate. So we debit cash income instead of cash principal for the 4 months after the date of death, how much interest was earned, and then we credit estate income. Then finally, what we do is we distribute some of it. So we distribute, and that goes to legacies distributed. We take it out of the cash principal. In this case, we were distributing the land also. And then we distributed some of the cash income. So sometimes in large estates, that could be to someone different, like this could be a different beneficiary, so that's why we keep it separate. And then instead of legacies distributed, it's income distributed, and then we take that out of the cash income. Okay, so that is doing journal entries on your estate. Then we move into Chapter 8, where we're translating the financial statements. So we've got an income statement, statement of retained earnings, balance sheet, and then the cash flow statements on the next page. So what you want to know is, like, what rates do you use? So with the income statement, we're always going to use the average exchange rate for the year, because sales and cost of goods sold and expenses are coming all throughout the year. So we don't have a specific like year-end date or beginning of the year date. It's going to just be that average exchange rate. So then we calculate, taking it from, this would have been in British pounds, and then putting it into US dollars based on that average exchange rate. Then when we come to the statement of retained earnings, this number is normally going to be given to us. It's the beginning balance number. And then the net income rolls down from our income statement, so we don't translate that. And then the dividends are actually at that rate, because dividends are just paid once a year. So whatever the exchange rate is on the date the dividends were paid, that's how we're going to value those dividends. And then this becomes our ending retained earnings balance, which then rolls down into our balance sheet. Now the balance sheet, the vast majority of accounts are going to be valued at our end of the year rate, because that's what these balances are. How much did we have on hand on December 31st? So that end of the year rate is $1.65. I just want to go. I guess I can't tally down, so I'll just keep talking. Okay. But then the one things you want to focus on is our common stock and our paid-in capital. Those are at a historical rate. Whatever those common stock were issued, what was the exchange rate on that date? So you can see it's quite a bit lower. So that's how we value those. And again, the retained earnings rolls down from the statement of retained earnings. So then what I've done over here is I've done a subtotal. So if I added everything up prior to getting to this last line, I had $10,291,596. I need my assets to balance with my liabilities and my equity, so I need a plug in there. So I subtract those and I see, okay, the cumulative translation adjustment is my plug, and it's $1,201,611. Then if we move to the next slide, then we've got our statement of cash flows. And that is going to be primarily at that weighted average number, especially in the operating section. When we come down to the changes in property, plant, and equipment, if it's just one major purchase, they will give us what the exchange rate was on that major purchase date. And the same with the debt. If there was just like, we issued bonds or we got a loan on a certain day, they'll give us what the exchange rate was on that day. Again, dividends are only issued on one day, so we have the exchange rate on those days. Then we'll add this up to get to our change in cash. We'll compare that to cash at the beginning of the year, to cash at the end of the year, and again, there's a plug. So then, because we're looking at it saying, okay, if this was my change in cash, I add that to my beginning of the year, it should equal the end of the year, but it doesn't. So there's a difference in those translations, and that is the $161,467. So again, this number here is your plug. Okay, then our last chapter is chapter 13, and we have our partnership accounting. So in the first one, we have two partners that are coming together. So partner A is bringing in a business, and they give us the balance sheet of that business, and partner B is contributing $150,000 in cash. And they agree that the partnership should be shared equally. So if we look at if you look at your review sheet, the company that is being contributed by partner A has $200,000 of total assets, and then $100,000 of liabilities that are being assumed. So he's contributing $100,000 of net assets, and the other guy is contributing $150,000. So you can see that they're not equal. So if we are going to record that, and they have to share equally, if we do the bonus method, which is what you see here, we're going to have the cash of $190,000 coming in, $40,000 that's on the balance sheet of partner A, $150,000 is what partner B has contributed. There's a receivable, there's inventory, there's accounts payable, and accrued liabilities that are all on the books of what partner A is bringing in. So then we look at that to say, okay, well, there's $250,000 of assets, net assets. So we're going to, bonus method means they just split them. So 250,000 divided by 2, each partner gets $125,000. In a sense, partner B is giving a bonus to partner A because partner A only contributed $100,000. But the assumption is that maybe partner A has some area of expertise, great sales, great customers, something that partner B is willing to pay that. Now you also want to understand goodwill. I don't have that written on the board here, but if we were doing the same thing, but it was a goodwill, we would look at it to say, okay, partner A is contributing $100,000 and partner B is contributing 150. So there must be an asset of goodwill, something that partner A is bringing to the table. So then we would record it. So here we would, right under the inventory, we would slide in goodwill at 50,000, and then each partner would have $150,000 of capital. So that's the goodwill method. Then this last one takes a partnership that's already in operations and kind of splits the profits and allocates out the profit according to the partnership agreement. So there's two partners and they each have $500,000 contributed into the partnership. They let a new partner in on June 1st, and that partner contributes $300,000. There's drawings during the year. That means they took money out. They cashed out some money. So partner A cashed out $25,000, partner B cashed out $25,000, and partner C, again, she was only there for half the year, cashed out $12,500. Then if we went through the partnership agreement, it says that partner C is going to be like a managing partner. So she's going to receive a salary of $80,000. They all will receive 5% interest on the capital that they leave in the partnership. And then they'll split the profits 35%, 35%, and 30%. So then if you, again, they give us the history of the income statement for the partnership. There was $1,250,000 in sales, $550,000 of operating expenses, so that leaves $700,000 to split. So then that's where we start right here to say, okay, we have $700,000. The first $80,000 goes to partner C because again, she's the managing partner, so she gets paid for that. Then that leaves $620,000 to split. Then we have to give each one of their interests. So 5% times 500,000 gives us 25,000. Same to partner B. Now partner C, it isn't as easy as just taking the 5% times the 300,000 because she wasn't there all year. She was there only for 7 months. So then 300,000 times that 5% times our time, which is 7 over 12, gives her $8,750. So then we subtract that out, and that leaves $561,250 to go towards the profit split. So 35% of that to partner A, 35% of that to partner B, and then 30% of that to partner C. So then you want to set it up in that format, and then that is your allocation. So this would be their capital balances at the end of the year.